Hi guys and welcome back to the channel. In this video I'll be sharing with you the top 5 stocks in the Danish market. I live in Denmark and that is why I know this market very well. So in this video I've picked out 5 stocks that I'll be going over. I'll be analyzing each of them a little bit and just giving you some reasoning behind why I've picked out these stocks. So these are all stocks from the C25 index. These are the 25 biggest companies in Denmark. It is basically like the S&P 500 in America, because Denmark is significantly smaller than America, so we only have 25. So quick peek over the companies we are going over. Here they are. So yeah, I've picked out 5 companies from all of these 25. And we're going to take a look at them. Let's get right into it with the first one, which is Maersk. I've done a video on this not too long ago, so go and check that out, linked up here. A little bit about Maersk. Maersk is a logistics business. It is the biggest company in Denmark, and it is also the world's biggest container shipping company. The whole pandemic has really skewed Maersk's stock price. You can see first we had like 50% decline in price, and then we have since shot up like 250%. And now we have declined like 20% again here, with the whole market kind of being on fire here for the last couple of weeks. Looking at the numbers, Maersk seems to be a really good value investment. We are only laying at a 6 times price to earnings ratio and a forward P of a little bit less. We have a price to sales of 1.07 and we have a price to book ratio of 1.5. So the valuation that analysts put on Maersk is significantly higher than what we are laying at right now. You can see we are 40% undervalued. I do want to say there's been some crazy short-term earnings growth because of the pandemic, because of the container prices just tripling in price. They have made so much money in the past year, which is great. But if we're looking at the future growth, we can see a decline of 26% yearly, because the year-over-year earnings growth has been almost 800%. So obviously we are not going to grow 800% a year in earnings, so that is bound to decline. The financial health of the company is great. You can see the long-term assets versus the long-term liabilities. The assets cover the liabilities almost 3 times, and the short-term it's also almost double the coverage with the assets. So yeah, really great financial position. Also, that is of course boosted from the past year. They are really reinvesting and buying even more boats so they can ship even more, and they're expanding in every part of their business. So dividends of the company is 2.14%. The management team is great and they have been here for a long time, so they know what they're doing, and that is not something to worry about. So all in all, great company. That was Maersk, and let's move on to the second one, which is Vestas Wind Systems. Vestas Wind Systems manufactures, installs and services wind turbines worldwide. Looking at their website, we can see they're just all over the world installing these off and onshore wind farms. And this is a market that they are really dominating. Vestas is the world's biggest windmill manufacturer. You can see the stock price, we have went up 100% or so after the pandemic, but then we have kind of dropped again here with the whole drop of the clean energy sector. We're kind of just trading up like 10% up and down here for the past 3 months or so. This is a stock that I bought around here a little bit before the peak, and I held through all of this, and I sold at some peak over here and made a little bit of money. And I've really been wanting to buy this stock again. There's been a recent dip here with the whole market, and I really wanted to buy, but now it has went up again. So I'm kind of pushing that decision a little bit. But this is definitely a company that I'm looking to buy in the future. Analysts think that Vestas Wind Systems is 7% undervalued. And if we look at the statistics here, you can see that we have a trailing PE of 34, and we have a forward PE of 30. So you might think that a forward PE of 30 is a lot. It is simply because the renewable industry is forecasted to grow so fast in the future. And if something is forecasted to grow very fast in the future, well, then you are going to pay a higher price for it now. So that is simply why the trailing PE is laying at these heights, which is not even that bad. Future growth is also looking very nice. You can see 17.8% annual forecasted earnings growth. If we can hit those numbers, well, then we are basically on the way to the moon, and that would be great. Some analysts say that Vestas is operating with too much debt, and I just want to say, making windmills there's a lot of debt involved with that. You can see here the short-term financial position is where people get worried. They look at this and they see that the short-term liabilities exceed the short-term assets. But in the long term, we are like a 3x coverage, so we're pretty good there. It's short-term that people are worried. So that is something that you will have to look into yourself. Also, you could subscribe to the channel because I'm coming out with a video shortly on Vestas. Dividend is not something that you are going to want to invest in Vestas for. You can see we are laying at 0.5% and it's not very stable. It's just kind of flying all over the place. So Vestas is definitely not a dividends stock. The management team is also something that people get worried about. They have just gotten a fairly new CEO, so that kind of puts some pressure on the stock price, because often the times when a new CEO comes to a company, then he will take the losses from the previous CEO very quickly, because then he will kind of have a clean sheet of paper. He won't hold on to the losses from the past, from the other CEO, because then he will look bad. So he will just kind of take those losses now and say that was his fault, and then it's all clean and he can proceed. So that is why every time we get a new CEO, things are going to go south for the stock price. And obviously that has been the case for the past couple of months, along with other things such as inflation that is forecasted to be a lot higher. Now let's move on to Rockwool International. Rockwool International, well, they are making stone wool and they are making installations for homes, and it's basically much more affordable now and it's better for the climate. So let's look at what the analysts think about this company. First of all, just a short description of the company. Rockwool, together with its subsidiaries, manufactures and sells stone wool insulation in Europe, Eastern Europe, North America, Asia, and internationally. So analysts are saying that it's 2% undervalued right now. And that might be fair, but we have seen numbers rise significantly for this company. Take a look at this forecasted 9% annual earnings growth. 9% for a company like this, that is great. You have to think about the previous company Vestas with a 17% earnings growth. That is a company that works a little bit more in a renewable, clean energy. This company is also focusing on the environment and being sustainable, but I don't think in the way that Vestas and people kind of perceive windmills and wind turbines being a little bit more renewable than Rockwool, although it is another aspect of sustainability that we will have to look into. So a 9% earnings growth here forecasted is great for a company like this, which suggests that it should have a pretty high PE ratio. Trailing PE, let's take a look at it. Right here, 25 trailing PE. I'm happy with that. And also the gap between the forward PE and the trailing PE is pretty significant, and that suggests that either the stock price will go down or the earnings will go up, and that is probably the latter, because we have a 9% earnings growth forecasted for this company. Here we are basically golden for this company, especially in the long term. Rockwool is not really operating with that much debt, and that is why the liabilities for the long term are down here in the dust. So long term we are good, short term we are good as well. So that is basically that. You can see the debt. They're not using debt in this company, and that is something to consider with inflation right now. And inflation is something to keep in mind when we're talking about companies, especially companies like Vestas, because they are operating with so much debt, and if suddenly interest rates start rising, well, then it will be more expensive to take on these loans, and that means that that will cut into their earnings. So this company is basically free of that. Rockwool is debt free. Dividends, we're also a solid 1.12% dividends. The management team is also nice and experienced, and they really know what they're doing. I've listened to some conference calls and they really seem to know what they're doing. And I'm also personally an investor in the company, and I'm holding my position. Although I had a bit of pain recently, because I've held where did I buy? I bought here. I bought here, so I made 45% on this recent rise. I lost pretty much all of my gains from this recent crash. We've recovered a bit. I kept saying I want to sell and get those gains every time, but then it went down a little bit more and a little bit more, and I wait to a green day, but then kept going down, and now I've just kind of decided to hold it and also maybe buy some more if it goes down further. So that is kind of how I look at Rockwool International. Great company that I definitely recommend that you look into. Next on the list is Pandora, and if you don't know what they are doing, well, they are making jewelry, all kinds of jewelry, and they are basically they have brand ambassadors like famous celebrities, actors, models, and yeah, that is kind of how they do their thing. They have bracelets and necklaces and earrings and rings and all sorts of things, and they do a lot of advertising on the Instagram and stuff like that. And Pandora has been through some ups and downs. We can say that went from 900 kroners down to 200. Not too good. And we have recovered here over the past year. Crazy ride for the company, and let's take a look at some statistics about the company, because we're sitting at a trailing PE that I think is pretty good. We have a 21 price to earnings ratio. I think that is more than reasonable, to be honest, especially when we see the forward price to earnings ratio being at 17. Also, the market cap, which is the value of the business determined by the stock market, is laying at 80 billion. And if we look at the enterprise value, which is their equity plus their cash minus their debt, so basically the true value of the business, it is higher than the value that the market is determining. So that means that we're basically we're buying $1 for less than $1, and that is great. It is trading 40 percent points below our estimates of its fair value. The earnings are forecast to grow 11% a year, and earnings grew by 164% over the past year. So they have been executing, and they have been really, really great over the past year. The valuation, 40% undervalued. Listen, guys, if you're not already looking at the Danish market for potential investments, go and do that. Actually, look at the whole all the Scandinavian markets, Sweden, Norway, Finland, because there are really some great investments to be found in here. And also, I think it's a great idea to diversify out of the American market right now, because inflation is coming, and it is already here, and there's coming a lot more of it. So I definitely recommend start to buy in some other currencies, in euros, and of course all of these companies are listed on several stock exchanges, so you can buy them in pretty much any currency. But start diversifying into other foreign countries. That is definitely a great idea. So valuation is looking pretty sweet, and the future growth is laying at 11.4%. This is also very, very high, especially when it's not a company in the renewable energy sector. It's not like that, so we are really, really getting our money's worth when it comes to this company, because we have a trailing PE laying at only 21. Financial health, you can see short term also, we are a little bit tight, just like with Vestas, and long term we're also just great, but they are operating with debt. You can see that, and they have been in an overload of debt here the past couple of years. Now they've seemed to broken out of that, and we can see that they're really, really reducing that debt to equity ratio. These lines are tearing apart from each other. The debt is heading straight down to the ground. So I think that is a very, very good sign. This stock is also something that I would consider a dividends stock in the Danish market. We have a 2.2% dividends yield. This is not too shabby, to be honest, and you can see that the dividends yield has been going up and down, so it's not the most reliable dividends that we can find in any company. But if we're staying on this track, well, then we're going to earn a lot of great dividends, and also hopefully a lot of nice growth. The management team also looks to be half decent. They have 3.2 years of average tenure, so they're not all newbies to the game. They know what they're doing, and it seems to be all right here. I don't own Pandora shares myself, but it is definitely one that I'm starting to look into more and more. So valuation is becoming more and more attractive for me. I looked at it a year ago or something like that, and it was not really an investment for me. Same with Rockwool International, not really an investment for me a year ago, but now it is. So now I want to buy more. A lot of stocks has really surprised me like this because of the recent earnings growth that has been happening. Whole economy is booming, and when is it going to stop, right? So I don't know what it's called in English, but basically a company that makes beer and brews beer and stuff like that. So a brewery, I'm just going to call it that for now. You'll have to live with that. So there are two big breweries in Denmark. One of them is Royal Unibrew, and the other is Carlsberg. Carlsberg is also a decent value business, so I would consider also investing in that one. But right now I'm kind of looking at Royal Unibrew. Not that I'm really considering it, because it's not really a sector that I really want to get into, but you know what? The beer tastes pretty good, and it's a very, very stable business. So let's take a look at this. Royal Unibrew produces, markets, sells and distributes beer, malt, soft drinks, ciders and ready to drink products. So right now we can see that they have a good bunch of rewards here. It is trading 21% below estimates of the fair value, and earnings are forecast to grow 7.6% a year. Great for a business that is so stable. And earnings have grown 10% this year. So here you can also see Carlsberg is laying here. Also got a nice big snowflake here. So Carlsberg is, as you can see already here on this little diagram here, you can see it's more to the dividend side of things. So if you're looking at a stable company that has some decent earnings growth over the past year and forecasted also, well, then you can look at some of these companies for being also great dividend stocks. So stable dividends in these companies. Let's take a look at the valuation of the company. You can see it's 21% undervalued. So yeah, that is pretty good. And you can see the trailing PE right here is 30 times price to earnings ratio. Apparently there's no forward PE on the company right now, and it's probably because it's a Danish company and it's not probably not that many analysts on it. You can see here what have we got. We've got 6, 5, 10 analysts on the stock. Most of the Danish companies, they're not that huge like compared to some of the American companies that you're maybe usually investing in. I don't mind paying 30 price to earnings ratio on this company because it's a stable company. It doesn't really affect the world, the outside world pandemic. It doesn't really affect the company in such a huge way. And yeah, also dividends, we're taking a look at that in a bit. And the value is decent on the company. So combine that with the fact that we have a 7.6% annual earnings growth, forecasted annual earnings growth. That is decent for a company that makes beer, brews beer, and nice beer and beverages like that. Financial health. Here is where the company kind of, they're operating with a lot of debt in the short term. You can see here, short-term assets do not exceed the long-term liabilities. And long-term, of course, it's another story, but here we have some issues here with the short-term. You can see the debt to equity ratio, as you can see here, is very, very high. So that's something to consider when buying the company. Maybe Carlsberg is a better choice. But dividends is something that you definitely get your share of. You get a nice 1.5%, and it is pretty stable. You can see over the past, like, what is that, 6 years, it has been almost the same, a little bit higher and a little bit lower. Carlsberg, even more dividends, even more stable and higher payments. If you want to look into that, well, then make sure to subscribe. And I'll make sure to look into that company with the stock analysis in the future. The management team is the last thing that we're going to look at here. The management team, the board of directors here, are nice and tenured. They are 3.5 years of average tenure, so they're not new to the game and they know what they're doing. So that is the story about Royal Unibrew. Those were the 5 stocks. I hope you learned something in this video, and definitely go and check out the Scandinavian market. Go look beyond the borders of America and start looking a little bit into Scandinavia, because that is really where you can find some awesome deals. Also the Danish market, if you just buy the C25 index here, that is also great value. It is like a PE ratio of 14 or something. Compare that to the US market, which is laying at a cool 21, I think, right now, average. So yeah, you're getting a little bit more for your money's worth here in Denmark. But that is something that I'll leave you up to decide. With that said, I hope that you liked the video, and I hope that you will smash the like button and subscribe. And yeah, I'll see you in the next one. Bye.